A medical bill can wreck an otherwise careful budget, especially when your health plan requires you to pay more before insurance begins sharing the cost. But there is a tool that can help you handle qualified medical expenses today and potentially support healthcare costs in retirement: a health savings account, commonly called an HSA. Used carefully, it can protect your cash flow now while building another layer of long-term financial strength. An HSA is not simply a savings account with a medical label. It comes with special tax treatment, but eligibility depends on the health plan connected to it. You generally must be enrolled in an eligible high-deductible health plan, often called an HDHP. The exact requirements can change, so check your plan documents and the current Internal Revenue Service, or IRS, rules before contributing. The phrase high deductible describes how the plan shares costs with you. You may pay more out of pocket for covered care before the plan begins paying according to its terms. In exchange, the plan may have lower premiums and may allow HSA contributions. That trade-off can work well for some households, but it is not automatically the best choice. A lower premium does not help if one unexpected bill would force you into expensive debt. The HSA's biggest advantage is often described as a triple tax break. Contributions may reduce your taxable income depending on how they are made and your circumstances. Money in the account can generally grow without yearly tax on interest or other earnings. Then, withdrawals used for qualified medical expenses can generally be tax-free. Few financial tools combine those three benefits, but the rules matter at every step. Start with the health plan, not the account balance. Compare the monthly premium, deductible, out-of-pocket maximum, employer contribution, network, prescriptions, and expected care for everyone covered by the plan. Ask yourself what would happen if you needed urgent treatment early in the year. Could your emergency fund cover the required cost? If not, the HSA opportunity may need to be balanced against the risk of limited cash access. A regular flexible spending account, or FSA, can also help with eligible healthcare costs, but it is a different arrangement. An FSA is usually tied to an employer and generally follows its own deadlines and carryover rules. An HSA belongs to you, not your employer, and can usually stay with you when you change jobs. Because plan designs vary, compare the account rules directly instead of assuming one is always better. Imagine you are in your 30s, your income is steady but not unlimited, and you are choosing between two health plans during enrollment. One has a higher premium and more predictable costs. The other has a high deductible and an HSA. The right decision depends on your health needs, available savings, employer contributions, and ability to absorb a large bill. There is no prize for choosing complexity. If an HSA-eligible plan fits your situation, open the account through the approved provider connected to your employer or plan. Confirm that contributions are actually reaching the HSA, whether your employer adds money, and whether payroll contributions receive the expected tax treatment. Keep the account information with your important financial records. Small administrative steps can prevent large surprises later. Choose a contribution amount that supports your full budget, not one that makes rent, groceries, debt payments, or emergency savings unstable. You do not have to fund the account perfectly to benefit from it. A manageable automatic contribution can be more useful than an ambitious amount that must be stopped after one difficult month. Proven savings strategies work because they are repeatable. When a medical bill arrives, decide whether using the HSA now protects your finances. Qualified expenses can include many common healthcare costs, but eligibility depends on current IRS rules and the details of the expense. Use the HSA debit card only when you understand what is being paid. If you pay with your regular checking account, you may be able to reimburse yourself later, provided the expense qualifies and the account rules are satisfied. That reimbursement option is one reason receipts matter. Save the bill, proof of payment, explanation of benefits, and any other record showing what the expense was and when you paid it. Digital copies can work if they are clear and backed up. Label each record in a simple system. The goal is not perfect paperwork. The goal is being able to explain the withdrawal years from now. What if you pay a qualified medical expense today but leave the money in the HSA? In some situations, you may reimburse yourself later, as long as the expense happened after the HSA was established and you have not already been reimbursed elsewhere. The money could remain available for future care or retirement. This strategy requires disciplined records, because a forgotten receipt can turn a useful option into a confusing one. Never treat the HSA like a general spending account. A withdrawal for a non-qualified expense can create taxes and, in some circumstances, an additional penalty if you are under age 65. The exact treatment depends on your situation and current IRS rules. Before taking money out for anything unrelated to healthcare, pause and verify the consequences with a qualified tax professional. An HSA also should not replace an emergency fund. An emergency fund is cash set aside for unexpected needs, such as a job interruption, urgent home repair, or essential transportation expense. Your HSA is designed around eligible healthcare costs. You may need both, an emergency fund for broad financial shocks and an HSA for medical costs. Keeping those purposes clear makes a stressful decision easier. For a household, the account can improve coordination. You might track the deductible, schedule preventive care, store receipts in one shared folder, and decide which bills are paid immediately. If a spouse or dependent's expense is eligible under the applicable rules, it may qualify even when that person is not the account holder. Confirm the details before withdrawing, especially when family coverage and tax filings are involved. Changing jobs usually does not erase the money already in your HSA. The account generally remains yours, although fees and investment features may differ between providers. You can ask whether leaving the account where it is makes sense or whether a transfer is available. Avoid rushing. Review the balance, records, fees, and access before making a move, and keep copies of important documents. Changing health plans creates a different question. You may be able to keep and spend the HSA money you already accumulated, but you generally cannot contribute during months when you are not eligible. Starting a new qualifying plan may restore eligibility, subject to the rules. If you enroll in Medicare, contributions generally must stop, so coordinate the timing carefully and confirm current guidance. The retirement potential comes from patience. Healthcare costs often rise with age, and an HSA can provide a dedicated source for qualified expenses later. If current bills are manageable and your emergency savings is adequate, leaving some HSA money invested or saved may give it more time to support future needs. That does not mean ignoring present care. Health is not a bill to postpone for a spreadsheet. Some HSAs offer an investment feature after you meet the provider's requirements. If you use that feature, keep the choice simple and aligned with your time horizon and comfort with market changes. Broad, diversified index funds are a basic category many financial experts discuss, but no investment is guaranteed, and availability varies by account. Money needed for near-term medical bills generally belongs in a stable cash option. A practical order can keep the strategy grounded. Maintain enough cash for likely medical costs, build a basic emergency fund, capture any available employer HSA contribution, and then consider additional long-term saving based on your overall plan. High-interest debt may deserve priority too. APR, or annual percentage rate, is the yearly cost of borrowing, and a high APR can grow faster than a cautious investment strategy. Consider a worker who begins by contributing a small amount, uses the HSA for an eligible prescription, and saves the receipt for the transaction. Months later, a family medical visit creates another expense. Because the records are organized, the decision is clear: reimburse now for cash flow relief or leave the money invested for later. The important progress is not the size of one contribution. It is the creation of reliable choices. There may still be setbacks. A surprise procedure can consume the balance. A paycheck change can interrupt contributions. A provider fee can go unnoticed. None of that means the strategy failed. Review what happened, restore a manageable contribution, and rebuild the cash portion before taking on more investment risk. Financial experts generally emphasize consistency and recovery, not flawless execution. Once a year, review the account like any other important part of your financial life. Confirm eligibility, contributions, employer deposits, qualified withdrawals, receipts, beneficiaries, and fees. Check whether the account's investment choices still match your needs. If tax forms arrive, read them carefully and keep them with your records. When a question is unclear, the IRS guidance or a qualified professional can help you avoid an expensive assumption. The account can also make conversations about money less tense. Instead of asking whether a medical decision fits this month's checking balance, you can look at the health plan, the HSA balance, the emergency fund, and the expected bill together. That shared information supports calmer choices. For couples and families, clarity is often more valuable than finding a perfect answer. There is a broader benefit too. When ordinary households understand deductibles, tax treatment, receipts, and account ownership, healthcare decisions become less mysterious. You are better prepared to compare coverage during enrollment, question a confusing charge, and recognize when a tax claim needs verification. Knowledge does not remove every cost, but it can reduce avoidable mistakes and help you protect the money you already earn. After age 65, the rules change in an important way. HSA withdrawals for qualified medical expenses can generally remain tax-free. Withdrawals for other purposes are generally taxed as ordinary income, but the additional penalty that may apply earlier generally no longer applies. Medicare enrollment also affects contributions. Because timing and eligibility can be complicated, confirm the current IRS and Medicare rules before making retirement decisions. Think of the HSA as one piece of a larger plan, not a magic solution. Your 401k, individual retirement account, emergency fund, debt strategy, and insurance coverage each serve different purposes. Compound interest means earnings can generate additional earnings over time, but growth is never guaranteed. A strong plan is usually built from several understandable habits rather than one dramatic move. Your next step can be simple. Read your health plan's eligibility details, compare the total yearly cost, check whether your employer contributes, and choose an HSA amount your budget can sustain. Then create a receipt system, keep enough cash for realistic medical needs, and review the rules before taking money out. If the plan does not fit your finances, choosing differently is not a failure. It is informed decision-making. The lasting payoff is not just a tax benefit. It is the ability to face a medical expense without immediately derailing your budget while preserving another possible source of support for retirement. You are allowed to start small, ask questions, and adjust as your health, income, and family needs change. With clear records and steady choices, an HSA can become practical protection today and greater financial flexibility tomorrow.